Housing prices are at an all-time high, and it's no secret why. The economy is booming, people have more money to spend, and mortgage rates are still low. But even with these factors in play, you might be wondering why housing prices haven't fallen yet. After all, we've seen this kind of thing before, home prices rising for years on end before the market takes a downturn. So, if you're wondering why housing prices haven't come down yet, or what might cause them to fall again soon, if they do, keep watching. We'll tackle those questions here. There are 7 possible reasons why I personally think the housing prices haven't fallen yet. Supply and demand. In general, low inventory and low interest rates tend to keep home prices high. When people think that their home is worth a lot of money, they're more likely to sell it for a price at or above that level. This means there's less supply than demand, which keeps prices high. On top of that, low unemployment, currently around 3%, low mortgage rates, under 5%, and stable inflation mean people feel comfortable spending money on things like homes because they don't need as much money in savings accounts or CDs as they used to have in order to pay off larger loans over time. Lack of lending. One of the biggest reasons why housing prices haven't fallen yet is because banks are still not lending. Banks, who control much of the money in our economy, have been afraid to lend out money because they don't trust it as much anymore. They don't trust that if they lend you money, you'll pay them back, and so they don't want to give you a loan. But without a loan from a bank or other organization like one, how can anyone buy a house? This lack of lending means that fewer people can get mortgages and thus buy houses, which means fewer houses are sold and bought. This has helped keep prices high. Investors. It's not just homeowners who are helping to prop up the housing market. Investors have a lot of skin in this game, even though they don't live in their homes, says Ed DeMarco, former acting director of FFA. DeMarco says that investors have been buying up properties since the recession ended in 2009 and have helped stabilize neighborhoods where prices might otherwise have fallen further than they did. Nowadays, about half of all home sales are made to buyers who plan on living there themselves, a record high share, while another quarter goes to investors. Of those investor purchases, about 15% are used as vacation homes and 10% get turned into heirlooms. Many others sit empty because they were bought speculatively with no intention of being rented or lived in at all. Low inflation. The reason why housing prices haven't fallen yet is that there's low inflation, which means that people don't want to buy things like homes and stocks. As far as I know, a lack of demand for goods and services is what causes deflation, which leads to falling prices. So this isn't really saying anything about why housing prices haven't fallen yet. Inflation refers to how quickly the cost of goods and services are rising. If you have an economy where inflation is higher than normal, then things cost more than they used to, and people will be willing to pay more for them than before, so it makes sense that this could cause housing prices still be high despite their slow growth rate in recent years. Now that you've watched this video this far, please give this video a thumbs up. And also subscribe to learn about investing, the stock market, and making money. Now back to the video. People aren't selling. As you may have noticed, home prices have remained relatively stable since the Great Recession. There are several reasons for this. People are staying in their homes longer than usual. Typically, people move every 5 to 7 years. But now more than ever, Americans are staying put and refinancing their mortgages instead of selling, which keeps home values from falling as much as they otherwise would have. Many homeowners simply don't want to take a loss on their house when they sell it, especially if they bought at the height of the market. The value of your home may be less than what you paid for it, but it could still be far more than what you get if you sold it today. And that's still better than nothing. Some homeowners just really like living in their neighborhood and don't want to leave even if they can get away with paying less rent somewhere else nearby or moving into an apartment building closer by, whereas before owning was seen as an investment vehicle. Low foreclosure numbers. The number of foreclosures has been low, which is one reason why prices haven't fallen as much. People aren't selling their homes because they want to hold on to their equity, and that's a good thing. Homeownership in America is at an all-time low. With the rise in rent prices, it's becoming more difficult for people who work in cities with high housing costs like New York and San Francisco to scrape together enough money for a down payment on a home or condo. Housing prices are still considered unaffordable across most of the country, except for maybe Southern California. So it's no wonder that many Americans have chosen not to buy homes or condos anymore from fear of rising mortgage payments when interest rates inevitably go back up again after being artificially low since 2008. The situation may not improve much until we see more foreclosures pop up, but even then those numbers won't compare favorably with 2007, when there were 1 million foreclosures annually nationwide. Why are leading indicators signaling a market decline? Many experts agree that the housing market has peaked and will be in decline over the next 2 years. But why? One reason is because of the yield curve, which shows how long-term interest rates compare to short-term ones. When it's steep, meaning that long-term rates are higher than short-term ones, investors expect strong economic growth and inflation. When it's flat or inverted, long-term rates are lower than short-term ones. They anticipate slow growth and low inflation. The yield curve has been flattening since late 2017. Long rates have fallen while short rates have stayed relatively stable, causing an overall shift downward. This has been seen as a leading indicator for an upcoming recession because when people expect one thing to happen, in this case a recession, they adjust their behavior accordingly by moving towards safe investments like government bonds rather than riskier stocks or real estate. Conclusion: the housing market is a complex beast with different parts affecting each other in different ways. But we're seeing some trends that could signal a change in the near future. The most obvious one is inventory. It's at an all-time high. This means it may be time to put your house on the market so you can take advantage of these low interest rates and gain equity in your home before prices start going back up again. And that's it for this video. Thanks for watching.